And moving on from all that, our next guest is usually one for the Aussie market, but instead he's finding opportunity elsewhere. Let's find out which stock and why. Michael Goldberg joining us from Collins Street Asset Management. Good morning. What made you bust out of the Aussie market? What stock appealed to you and why?
Good morning, Annette. Good morning, Scotty. Look, the stock that we're going to talk about today is called Litigation Capital Management, and we actually first bought it when they listed in the Aussie stock market a few years ago. They since moved over to the London Stock Exchange, and given how much we like the company, we thought we're going to hold on to it. So just for some background, I suppose, litigation have carved out a great little niche in the litigation funding space. They've got a fantastic track record, they've got some wonderful people, and they've got some really exciting growth prospects. It's currently trading at the equivalent of $1.20. Obviously, it's quoted in pence, but for the purposes of this, it's $1.20 in Aussie dollars. But we think it's worth probably about $3 given the current earnings profile. And if they manage to achieve what they hope to achieve over the next couple of years, I think 2022, 2023, it's reasonable to expect that it'll be somewhere around or as much as $5 per share. So, it's a little company that we've been following for quite a long time. When you imagine the sorts of businesses or the sorts of cases that they take, think about commercial disputes, think about insolvency, think class action and arbitration, and as opposed to some of their larger competitors being IMF Bentham, which is now I think called Omni Bridgeway, and Burford's in the UK. Instead of looking for those big cases, their preference is to look for many medium-sized cases. So that way they're not looking to try and establish precedent. They're looking for things that are low risk, looking for things with highly predictable outcomes. And following that process over the last 10 years, although they've been around for about 20 years plus, they've managed to generate an internal rate of return of about 80%, which is, of course, phenomenal. Look, we just think that on the basis of our expectations for their earnings this year and next year, they're just too cheap based on their growth profile, but especially so compared to their peers.
Michael, so you've given us the bull case. What about some of the pitfalls that you should be aware of? I just know that there's been several listed legal plays through the eons of time that have not fared necessarily that well.
Yeah. Look, I think it's important to note that the litigation funding space has some significant tailwinds. It's important to notice that it's not really affected by market conditions or political change or by economic challenges. It's almost quite the opposite. Uncertainty tends to lead to increases in disputes, which tends to lead to increases in insolvency, which of course leads to opportunity for these sorts of companies. Now, litigation funders over the last 5 years, again, there's not a lot to pick from, but if you look at Omni Bridgeway and Burford's over the last 5 years, they're up about 200%. Now, I've heard the case made that you should be able to compare this sort of company to a Slater and Gordon, which I presume is the sort of company you're talking about, having seen divergent kind of returns from the funders. And I don't think that's a fair comparison. I think it's a little bit like comparing the fortunes of, say, basketball and golf. Both are sports for sure. Both of them you need a ball to play it. But that's about where the comparison starts and ends. Yeah, no doubt, both litigation capital and a multitude of legal companies are listed companies. And yeah, certainly they're reliant on the courts and legal system. But in terms of their fortunes, it's very hard to compare an operating business like a Slater and Gordon with a litigation capital management, which is essentially a managed funds business. Very, very different things, really. And in terms of risks, again, the addressable market for the litigation space is tremendous. I think it's some $73 odd billion across Australia, the UK, and the US of A. And just to give you a sense of how much the market is currently tapping, litigation in their most recent announcement came out and said they were accepting somewhere between 3 and 5% of the cases that were brought to them. So there's a massive market that's untapped. But generally speaking, there's competition risk, there's legislation risk. We saw the local regulators come out not that long ago and say that litigation funders need to have an AFSL. It's not a problem for litigation because they already had it, and perhaps it's a positive because it makes it difficult for other people to join in. But if the regulators can make some changes there, they can make changes elsewhere. Lower margins are a risk, personnel risk, no doubt, especially with litigation being a smaller company. If Patrick and his A-team were to be struck by lightning, that would be a problem. And perhaps I jest a little bit, but theoretically, world peace might crimp the growth profile of the litigation space, but I think that's a trade that most people would be happy to make.
Just quickly, what does earnings seasons meant for you so far? Are you pleasantly surprised, or have you seen some disappointments?
It's actually still too early to make those sorts of firm calls. The key themes that we've seen come through so far have been businesses looking to simplify their business models. Businesses are looking to digitalize and automate. They're looking to cut costs, and they're looking. The outlook has been cautiously optimistic. I think the challenge is, though, even with consensus, and I use consensus in air quotes, I don't think the investment community really had many expectations or really knew the impact on companies for the current period, given what we've gone through over the last 12 months. You look at Telstra and Challenger Group, both companies that I like historically. Both of them missed expectations, and both of them really, in the greater scheme of things, didn't really pay any price. Mm-hmm. I think most interesting for me so far, and I haven't had a chance to look at JB Hi-Fi. I was looking forward to that. I'll have a look at that this afternoon. But so far, for me at least, the Commonwealth Bank report was quite enlightening. I haven't made it through the entire 100 and something pages, but some of the key themes that I've seen, certainly around the loan growth and the business growth, has been that the impact of JobKeeper and JobSeeker was more significant than what we anticipated. I think that if that holds true, that once COVID and the challenges associated with it washes through, based on some of what I've read so far, we could be in for a much quicker recovery than I initially anticipated. I'm still very much cautious. I'm still very nervous about expensive markets, but I think there are certainly some positives on the horizon, and I'm pretty sure it's on a train at the end of the tunnel, but perhaps daylight.
Yes, the CBA, as the largest Australian listed bank, pretty good marker for what's going on in the broader economy. So interesting to see what the other banks report when they go and give their trading updates in the weeks ahead. Michael Goldberg from Collins Street Value Fund, thanks for joining us on the program today.
Scotty and Annette, thanks for having me.